Sambhav, first of all, thank you so much for joining us for this session. Before I pass it on to you, I want to set up the context. This is part of the series of Leap to Unicorn Season 2, which is an initiative by IDFC FIRST Bank and CNBC Network 18 television to support and first of all to find out startups, most promising startups from in early stage from all around the country, uh, get them the right set of mentors in place for through a boot camp, get them with the with a visibility pan India, and most importantly, get funds mobilized in their company. In the last season of Leap to Unicorn 1, uh, we had a great achievement where 90 crore worth rupees were mobilized, were funded in 6 companies in the final round, where 6 VCs participated. This time, we have a commitment of 65 crores, and we are trying to increase this number, uh, maybe beyond what we get last time. This initiative is the application for Leap to Unicorn 2 season 2 is closing on 31st of January. So people who are participating here, first of all, I am expecting that you guys have already applied for it. If not, we are very close to the end date. Do not miss out the opportunity. It is a great opportunity for you to be in the limelight, to be visible to 135 crore people through the right partner as this program. This particular episode, I'm very excited about, and glad that Sambhav accepted our request to come and share his perspective. Sambhav Mehrotra, he's the partner of Startup Movers, a dear friend, and somebody who has expertise in in the startup world, in services related to startups around CA, accounting, and structuring the ESOPs for companies. Without taking much of time, I would request Sambhav to give a short introduction about him, of course, and then take us through because and I want to add one more thing to you. We are overwhelmed with the kind of response we have received from all of you. We have a list of questions, more than 50 questions we received in last 72 hours from all of you. We have done some homework around that, and we have picked up some of those questions, and there was a good number of questions were overlapping. So we have done some homework in terms of identifying what are the areas that should cover. And I know Sambhav has spent hours in coming up with a presentation which addresses most of the questions. In case he miss out anything, I have the list. Don't worry, I will not leave Sambhav without answering those questions. So Sambhav, over to you.
Thank you, Dr. Sunil, and it's a pleasure to be on this platform and sharing a little experience that we have had in the last 10 to 12 years. So I'll just give a little background. So I'm a qualified chartered accountant by profession, and I've extensively worked in the Indian startup ecosystem, now diversifying globally. And the Indian startup ecosystem has been my niche since 2009. So we've seen one whole cycle where we've seen the unicorns built and a lot of failures that have happened. And we've got a plethora of founders' experience to share with the ecosystem. So I'm a general practitioner. I work around a lot of specialists around my team. So I will cover around 80-85% of the technical aspect. But bear with me if you have some interpretation issues on some law, or you have some special query that we might not have an answer to this. But I promise I'll come back with that solution to you. So we have this entity, Startup Movers. The idea here is we want to provide end-to-end legal and financial services to the founders so that we can create the most important currency for them, which is time, which enables them to focus to build the core, especially on the early stage. So typically we kind of focus on very early stage founders pre-incorporation itself, and the life cycle continues till about Series A, post which there is ideally a in-house team that's built out, or a big four then comes in. So we want to be a part of that growth story. Ever since 2009, we've seen more than 500 plus growth stories in sector agnostic space. And ESOP has been one of the key areas where we've seen a lot of pain points, and we've seen a lot of white space which still needs to be filled up in terms of understanding how the ESOP system works. So pretty excited to move forward with. Dr. Sunil, you want to add something, or I can share my screen?
Please go ahead, sir. I'm very excited about the conversation we are going to have in next 40 minutes. 50 minutes, sorry.
Great. So I've shared my screen, just confirm that's visible on the screen. Yeah, perfect. So yeah, thank you for having us. The topic that we have for today is demystifying ESOPs. So we'll try and keep it in a very common man's language, so that we are able to decode the complexities and technicalities involved, especially from Indian compliance landscape. So what we'll discuss today, we'll have a fair bit of bird's eye view understanding of what are ESOPs and what are its benefits for the entity and as well as for the employee. How do you value the company for ESOPs, at what intervals, what timelines? What are the tax implications for the company as well as for the employees? Briefly touching upon how ESOPs works in case of a holding subsidiary structure where holding company is out of India. Then we'll cover up use cases or real life examples of the mistakes that usually management or the founder is doing, not consciously, but it happens in the absence of a required technical knowledge, which comes in at a very late stage as a reaction versus a proactive approach. So we'll look at some mistakes that can be avoided while deploying the ESOP scheme itself. And then lastly, we'll touch upon a topic of SAR, which is an alternative to ESOP, because there are a lot of questions that pop up that we have a consultant or an advisor whom we want to give an ESOP, but unfortunately, ESOPs are only for employees. So there is my personal preference, call it a jugaad, because this is unregulated. So we'll touch base on this aspect also of how we can use SARs in place of ESOPs for employees or for advisors or for consultants that you want to bring on board. Just to begin with, just setting up a context to get the eyes rolling, as visible on the screen, for one of the first employees of Alibaba, who was just a receptionist and then later on took senior roles, had 0.2% of the company in 2000 and ended up making $320 million in 2014 when the company went public. So that's the power of ESOP. The only thing is its exception, and you can see that exception on the eyes of the person who's looking behind, that how is that possible. So of course, all ESOPs are done with this intent of creating value for the employee who's taken that risk. For a listed entity, for an established entity, you might have a lot of established track record to ascertain what kind of benefits will come to you. But in startup ecosystem, it's like absolutely to say like a gamble. It can just turn around into a plethora of wealth, or it can just be nothing at all. What are ESOPs? ESOPs are employee stock option plan. They are compensation programs that gives partial ownership of your company to your employees who get equity shares in lieu of these options. Company grants these options to employees to acquire equity shares at a future date. So you're giving them an option to be a part of the company today in some future event on certain predetermined terms and conditions, which also includes timing and pricing. So you are asking your employees to be an owner in your company, but not today, as a part of a predetermined process where a price, process, and timing is determined. Why do we want to give ESOPs? Is it just for acquisition? Is it just for retention? It covers a lot of aspects. So first is it gives a sense of ownership and engagement to employees. It offers it acts as a retention tool. So of course, in startup ecosystem, the first and the foremost is because you don't have resources early on. You need to get and attract senior talent, right? And since you do not have sufficient resources at that point of time, ESOPs kind of plugs in that gap where that senior resource might be willing in the team or the idea and is willing to forego a cash outflow for a portion of ESOPs that is given in lieu of the same. So that is the way to attract. And then retention is, it can be linked to performance. It can be linked to a culture also where you are giving ownership to the concerned employees, which kind of acts as a retention tool as well. It aligns the interest of the employees. Of course, if I have an ownership stake in the company, I will suo moto be aligned to the long-term interest, try to align the culture, processes and everything. As both when employees and shareholders have common vested interest, it actually impacts the growth and the profitability as well. It can be structured in a way, like we said, there is retention, there is acquisition, and then there could also be a link to performance, right? So you can create ESOP policies. Of course, you can have X number of ESOP policies for X number of reason, and one of that could be a performance-linked policy where you are incentivizing employees to achieve certain targets. So that improves your productivity and efficiency overall. ESOPs gives employees an opportunity to accumulate wealth, like we discussed, right? Massive wealth created even in India ecosystem. One of the example is Citrus Pay, if I'm not wrong, where all the employees had ESOPs in the company, and even the peon made about 50 lakhs when the company got acquired. So as the company grows, it becomes more valuable, more successful. Ultimately, employees end up accumulating more wealth at the time of acquisition or say listing. In some cases, ESOPs can also influence corporate governance, as employees, owners may have voting rights and they can participate in major decisions. So once ultimately you get the ownership in the company, even if you have one share in the company, you have substantial voting rights that you can exercise, go to NCLTs, be participative in the decision making of the entity itself. So that's how ESOP kind of works in a holistic manner from an employee perspective to keep things aligned. Talking about an ESOP life cycle, so what you see on the screen is typically how it should work, but how typically it happens in the startup ecosystem is just the opposite, right? So we'll just see what the law says, right? First is you have to charter documents and memorandum and article for a private limited company. Of course, LLPs, sole proprietors, partnerships, they cannot do ESOPs. For giving ESOPs, it has to be a private limited entity. And if it is a private limited entity, your charter document, your AOA, MOA has to be aligned. And hence, you need to check the AOA that it allows the ESOPs to be given. The first thing is a professional will check whether your article of association is worded accordingly that you are able to give an ESOP policy. Then second is you will create a formal scheme. How many number of shares you want to be a part of ESOP? What kind of terms will be there? Who will be given? Who will not be given? So a broader scheme is created, which is done by your secretarial team, which is the CS, or a legal team that could be aligned with the CS team. Once you have the draft, you take an approval in the board meeting from directors and then subsequently from shareholders. Then you file to the ROC the relevant documents to establish a track record and a trail that, oh, now we have a formal ESOP policy in place. Thereafter, based on the terms of the ESOP policy, you need to give grant letters to your employees. The grant letter is the Bible for the employee, which will carry all the terms and conditions for the particular ESOP that has been given to the employee. That grant letter will also talk about the vesting period. How long will we'll talk about it in depth. How long will the vesting happen for that ESOP? And then finally, once that option is exercised, the shares will be allotted against the option within the given time period. How it currently happens in the startup ecosystem. I join a company, I am given a joining letter, which at the bottom says you will be given ESOPs worth 20 lakh rupees in due course, or you are eligible for 20 lakh rupees of ESOPs. And that's where it ends. So the startup might not have a formal ESOP scheme itself on that date, but by that letter, joining letter, a trail has been established that an employee is now eligible for ESOPs. But in absence of the right technical knowledge, it's more of an integrity arrangement between the employer and the employee. So later on, when a future round happens, that's when during a DD or as a part of the investor's requirement, it is asked that first create the formal policy, materialize all what you have committed to your existing employees as just an integrity document in terms of the joining letter. And whatever then you would have done, you kind of formalize this, do back-end working to come to date with what is the right process to be done. How does ESOP work? You grant the ESOPs, the grant letter will have the terms like for how much period the grants will be vested, whether it will be quarterly vested, yearly vested, monthly vested, what will be the exercise price when you will exercise your options, what will be the taxation implication that will be coming from the ESOP scheme. So once the vesting happens as per the grant letter, so supposing in this case, typically in Indian startup ecosystem, you will see 4 years of vesting period divided equally in each years with quarterly vesting. So 25% yearly, and it will vest year on year. So and that's where the choice of the founder comes in, that whether they want this to be monthly, quarterly, or yearly, which is where the employee retention becomes very critical. Now, if I have an yearly option, I might not be giving the right kind of mindset to the employee, who before joining will think twice or thrice that the value that is being created is at a risk, because if I leave during the year, I might not be able to sustain a lot of that wealth that I could have sustained if it's a quarterly vesting or a half yearly vesting. So that could be one point of negotiation. But for an example, in the continuing example, let's assume quarterly vesting for 4 years. So each quarter, a 6 point something percent will get released for the employee. And after that, so there is a necessary cliff period also in the Indian compliance ecosystem, that whatever ESOPs that you are giving, it will have a essential and mandatory cliff period of 1 year in which it cannot be exercised. So during this 1 year, if your employee is leaving the organization, there will be no vesting. All ESOP options that have been granted will become lapsed. So 1 year needs to be completed. Post that 1 year will be the subjective vesting schedule that you would have kept. Like in our case, we have said 4 years. So after 1 year, 25% of his options are available that he can exercise and take equity shares against the same. Likewise, as and when the vesting period will get finished, exercise of the options can be done and shares can be taken by the employee. And once he has the shares, he is at a discretion to sell the shares, which can be restricted by the ESOP policy, that what the management or the founder wants. Once this employee who now owns the share, can he give those shares back to the company? Should the company have the first right to buy those shares? All that can be streamlined and documented, where you can even restrict that your employee who has those shares, before selling it out anywhere in the market, will come to the company to sell it to you, which is called right of first refusal. So that's a bird's eye view of how an ESOP lifecycle works. What does the ESOP scheme cover? It basically will cover objects of the scheme. It will broadly say why and for whom we are creating this scheme. It will have an administrative authority. So there are two methods primarily where your ESOPs can work. One is a pure method where you are just creating a pool, and as and when the options are getting vested, you kind of issue new shares to the employees who are exercising the option. The other is called the trust route, where you create a separate trust, and at day zero itself, those number of shares you allocate to the trust, and then that trust manages the transfer of shares when the exercise of the options happen at the employee's end. Then third is who is eligible. So the scheme will give guidelines. Say somebody who's completed 2 years, or somebody who's joining at X hierarchy in the organization, or somebody who's done this level of performance. So that kind of things will be worded. The next is vesting schedule and condition. But from a practical aspect, this is something that you can keep open-ended in your ESOP scheme, and you can have different vesting schedule for different employees. The only thing is, while calculating the expenses and values, that will become very complicated. So that's why most of the times it's almost similar with for schemes. But there could be scenarios that you want to give 1 year vesting to one employee and 3 year vesting to some other. That is possible through your grant letter. So even if you have one scheme, you can have different vesting schedules. Next is what would be the exercise price, means what price the employee will have to pay when they exercise the option. And it is usually very, very low, about the 10 rupee price, which is the original share price that is there. Or in some cases, depending upon what kind of cash flow is required to administratively manage the scheme, or there could be a number of other reasons, this price could be anything, but it will be much less than the market price. The usual practice is 10 rupees or the par value of the share, which is the exercise price. Then it will also say exercise period, which is very, very critical in this ecosystem, and we'll also cover it in the mistakes part. As an employee, I worked for 2 years and now I have left the organization, right? and I have not exercised my option. What happens in this case, which is very, very practical in startup ecosystem. In the next slide, we'll talk about taxation. And that's where we'll get to know why this exercise becomes so much of a pain for an employee. And that is where, as a culture, a startup comes in, where even if you are moving out, startups can create a policy where even if you are exiting the company, they will give you a right to exercise it for indefinite period, so that you don't end up paying unnecessary tax implications or any cost. So this exercise period is something in some startups, they say, no, if you have left the organization, nothing doing, we'll lapse all your options. If you have not exercised it, you are responsible for whatever needs to be paid. And if you don't have liquidity, we are not bothered. Some examples that we have seen is people want to be employee savvy, even if they are parting ways from the entity, and they give them a indefinite or a fixed period, that even if you are going out of the organization, he'll give you 5 years to exercise your options. They will not lapse even if you're not associated with us. Next is lock-in period. Like I said, 1 year is a necessary cliff as per the law in the ecosystem. You cannot bypass this. That's my knowledge. Somebody can have a different interpretation. But whenever we've done ESOPs, 1 year cliff is mandatory. You can have a higher cliff also. Next is monetization mechanism. What happens in case of unlisted companies? The problem here is, if I'm a listed entity, my ESOPs are highly liquid. I can go out in the market, sell those shares, take loan against those shares from a NBFC, and plan my exits of the ESOPs. That is very much doable. Unfortunately, in private limited companies, especially in startups where there is no liquidity for selling those shares, sometimes startups create a policy that they might come out with a buyback policy, or they'll give a definitive a milestone that on this milestone we will be able to cash you out or cancel your options or pay you money. Some kind of those mechanisms can be drafted. Like I said, another thing is same as exercise period. What happens in case of cessation of employment? Those kind of terms will be in a part of the ESOP scheme. And then finally, how merger, bonus, etc. will work will be a part of the scheme. And then it will also talk about the tax implications, because tax is a very critical aspect when we talk about ESOP. So it might define who will be responsible for the TDS, how will that be collected, all sort of those things will be there. Moving on to how they're represented, right? So ESOP, let's first talk about how the startup or the company needs to disclose it in their financials. So ESOP is considered as expense in your books. So you are giving a 100 rupee share at 10 rupee to your employee. So this differential 90 rupees becomes an employee benefit that will need to be captured in the books as an expense. It is recognized over the period of vesting. So if this 90 is vesting over a period of 4 years, as and when vesting happens, you are going to amortize it over that period. It's a calculation. Then finally, how much of a dilution has happened because of EPS? Because usually the practices, the right practices, I've incorporated the company today. We are 3 co-founders. Our cap table is freezed. Before you go out to raise a round, you need to have a ESOP pool of 8 to 12%, which is the industry standard. Because what happens is, if I raise an angel round where there was no discussion around ESOPs, and then when you raise a subsequent round, your investor might not agree to dilute himself. That you want to build an ESOP pool, go ahead, but then you need to issue additional shares to me because I don't want to dilute myself. Or you might agree to with the investor beforehand that we do not have an ESOP pool today, and we'll bring it later and you will get diluted. So that kind of a transparency you need to have with your incoming investor. The practical and the right aspect is, once your company is incorporated, in your cap table, keep a 8 to 12% pool size defined before your next round get raised, so that there is no discrepancy or an investor relation getting messed up, that these ESOP should have come prior to our investment and we will not dilute ourselves. So as and when the shares will be allotted against this ESOP, everybody gets diluted. So investor also needs to know and factor in that ESOP has already been taken care in the calculation. And then finally, we need to disclose in the schedule 3 of the financials, what is the method of valuation that we have used. So there are 2 methods practically, and there are more now because the valuation standards are changing. One is the historical method and the other is called Black-Scholes method. Now, here comes the difference of opinion or interpretation issue specifically in terms of assurance and audits. Whenever your organization will grow, your auditor might ask you to do Black-Scholes model. The point there is at each grant date that valuation needs to be done. So if you have done 10 grants during the year, you will need 10 valuation reports of each grant date. So that is why it is recommended, don't keep so many grant dates, keep one grant date every quarter and then mix and match so that there are not many grant dates in a year. The historical method says that you can take the market value and then calculate it accordingly. So usually people use the DCF, or if they've raised around recently, that kind of valuation. But the accounting standard says even if you've used one method, in your notes to accounts, please mention what would have been the difference if you would have used the other method, so that there is transparency to the stakeholders that we are not cooking up the books. So the valuation method becomes critical. Both the methods need to be done. Keep your grant dates as minimum as possible so that number of valuations are not that much that are needed. Then the notes to accounts will also say how much of the options were granted, how many have been exercised, how many forfeited because people have left, and then how many are still running and outstanding during the year. So this full disclosure goes into your financial statements. At one stage, ESOP itself becomes a vertical to be managed in your company. It grows to that size. Then how do you value? So you need to value the option that has been given, and it is done based on a valuation method like we've already discussed. You need an independent valuation report from a registered valuer. The slide talks about book value and internal valuation. I'm not going in depth of it. Just keeping a bird's eye view that as per the accounting standards, valuation standards, company law, at each stage, you will, or say at each time interval when your books are closing, you will need a valuation report from a registered valuer, which is needed for doing your accounting, because you need to book your expenses in your books, give the notes to accounts as per the guidance note, to a certain tax, because based on the valuation report, we'll get to know what kind of perquisites need to be taxed, what kind of TDS needs to be deducted. And then finally, from the employee perspective, as a decision making, whether he should exercise it now or later, it becomes a critical decision to know the value as of today when he wants to take that decision. Coming to critical aspect, taxation, which is very, very critical. How taxation works in case of employees. Just before we finish this, I'll just cover up the topic of taxation for employers, where there is anomaly. Anomaly is there are both case laws from Supreme Court, where one case law says even if option is just vested and it has not been exercised, you can claim the expense in your books. The other side of the story says you can book the expense only once the option is exercised and you have done the tax compliance. So both side of stories exist based on who's doing your assurance audit and the relevant stakeholder. Relevant calls can be taken. So some startups are okay to book the expense in the early days. So they will say, we want to book the expense. Some startups are okay not to book the expense because they do want to show their actual operational profits. This becomes an exceptional item. So both kind of verdicts exist. So as a founder, you will need to take a call there. Now coming on the employee side, 3 stages we discussed. When I have given the grant letter, nothing, no tax implication, no value has been created. The options have started vesting. As and when an employee exercises that option, okay, now give me my equity share in lieu of this option, that difference becomes a perquisite, which is the pain point. Now, in our example, let's assume after 2 years, I exercise 50% of my options. The options were given to me at an exercise price of 1,000 rupees, but the actual value of the share today is 1 lakh. So I'm just getting the shares were worth 1 lakh rupees, which I have still not sold. But this different 99,000 becomes a perquisite. And on this perquisite, tax has to be paid under the head salaries, right? So what your employer will say is, oh, you are now getting this much perquisite in lieu of the exercise. Now 99,000, 30,000 rupees of tax needs to be paid. Either I can deduct it from your salary, and in n number of practical cases, your salary will be 1 lakh rupee and your TDS would be 5 lakh rupees because the value is so much. So in this case, the employer will say you need to give us 4 lakh rupees for the tax to be paid, and then you can exercise the option. Now, as long as it is listed share or a liquidity situation exists where the employee can sell this option or the equity share, he'll be more than happy to continue because he can take out the tax amount from the sale of share itself. But unfortunately, in startup ecosystem, the liquidity event is far off. So at this stage, it becomes a cash flow and a cost for the employee. And hence, you will see that in startup ecosystem, usually employees defer their option to exercise because they do not have that liquidity to pay the tax and take the shares in their name on that date. And then finally, once the shares have come to the employee, if he holds it for a definite period of time and then sells it, it is ideally treated as long-term, short-term gain. But when it is done, whatever is the value at which the shares were given. So in our case, the 1 lakh rupee on which he's already paid the tax. So when he sells the shares, his cost becomes 1 lakh rupee and not 1,000 rupee that he's paid. So in that way, he's still able to mitigate the tax implication when he sells the shares. We've already discussed. Employers are able to claim it as an expense, but there are two verdicts. Do we do it when the employee exercises it and we deduct TDS, or we do it right at vesting itself when we are amortizing it? Both options are there. You can take a call. Now, the problem that comes here is employers are required to deduct TDS when the exercise of the option happens, right? If your salary is 1 lakh, the TDS comes out to 5 lakhs, your employer will ask money from you. If your salary is 5 lakhs, this tax comes out to be about 2 lakhs, a mutual discussion will be done and TDS will be deducted, and then the shares will be given to you. Now, to mitigate this problem, what government said was, in any case, employees are unable to exercise their options because of the tax implications. We'll give you an option to defer the tax by 4 years. Though this law, from my personal perspective, is not very useful, we'll see in the third line. So what government says that your tax liability will arise within 14 days of these 3 events. So they are giving you 48 months, so 4 years from the assessment year in which the option has been exercised, or you have sold the shares in the open market within 14 days, you need to pay tax, or the last line becomes pretty tricky. From the date our taxpayer ceases to be an employee. Now, in the previous example, we discussed that as employee welfare, we are allowing those employees who have left the organization to exercise this option indefinitely at later point of time. But in this case, what they say is, even if you have a, say, deferment of tax, if your employee is leaving, irrespective of whenever he will exercise or she will exercise the option, they will still need to pay tax. So this provision becomes null and void for that employee. So that is why practically this becomes difficult. Plus, the challenge here is it is only and only meant for startups that have 80 ISC registration. So about 1 lakh, 1.25 lakhs registered startups, say by March, till about November or October, only about handful, less than 1,000 companies had 80 ISC. All of a sudden, something has happened in November or December on a single day, where about 2,000 to 4,000 registrations were done in one go. We are still trying to figure out what just happened, because if you see the type of organizations that got the 80 ISC, it raises some eyebrows that how are they eligible? So it seems like government has become a little liberal in selection of these exemptions, but still it just is about 1.5 to 2% of overall startups that are registered. So all the 1.25 lakhs do not get this benefit. It is just the 80 ISC one that gets this deferment benefit. And in case employees leaving the organization, in any case, this becomes redundant. Like we said, the sore point here is when the employee decides to change the job, this provision is of no use. So common mistakes that people do. There is employees. So first is founder doesn't have the right knowledge. Plus the employee who's joined doesn't also have the right knowledge. So it works on integrity in the initial days, which sometimes backfires later on. So the employer might have committed something on the joining letter, but now based on what the law says, they have to do backworking and it doesn't work. Vague or ambiguous language. I'll give you ESOP worth 20 lakh rupees for 2 years, and that's where it stops. And then later on, employer and employee get into a negotiation. Oh no, it has to be this way, it has to be that way. Lack of communication and transparency. Whenever we deploy an ESOP policy, we do 2 necessary trainings for the employees so that there is no misunderstanding between both the stakeholders. So the founder keep over communication, especially around ESOPs things. Don't keep unrealistic vesting periods. In our case, we saw one case where they kept 8-year vesting period. That doesn't work, right? You are deterring. Instead of using an ESOP policy, ESOP has become deterrent for people to join you. If there is no exit strategy for employees, they'll get distracted again. Like I said, some bonus payout, some buyback should be there, option cancellation option should be there, so that some liquidity is there for the employees in case there is no liquidity from an acquisition or an IPO standpoint. Then don't ignore tax and regulatory requirements. Even MCA is coming pretty hard on such filings. Compounding is becoming difficult. So as a legal and compliance framework, put the right framework at early stage itself. Don't keep it very rigid, keep it flexible, so that, like I said, don't keep your grants vesting period very rigid in your ESOP schemes. Keep flexibility in your grant letters, right? That helps. Keep a performance matrix so that you can substantiate how you have given ESOPs to employees who are already working, not the new ones that you've joined. Valuations should be realistic. They should not be based on unrealistic assumptions. DCF is a right method to use. Multiple might not be right method, because you can show rosy pictures, but at the end of the day, in future rounds, when your valuations drop, that doesn't make sense. And then do your regulatory filings and disclosures. We've seen cases where for 3 years, the founder was giving ESOPs on joining letters and there was no policy at all. So in the financials, even the auditor did not look at that point, and then it became an issue in the 4th year. When finally those whose vesting were finishing, they said, we need shares. And because there is mandatory cliff, it became a point of conflict between employer and employee, that they needed shares today. And now founder said, oh, I can only give you 1 year from now because the law says so. These are few things that there are a lot more. Of course, we can look at the questions that are left, but these are few common ones that exist in the early stage startup ecosystem. Lastly, talking about what is called stock appreciation rights. So people come to us saying that we have an advisor whom we want to give shares. Can we do a secondary transfer to them? Can I give ESOPs because I'm giving ESOPs to employees in any case? The problem is ESOPs can only be given to full-time employees. It cannot be given to part-time employees, consultant, advisors, anybody else. Now, one way to do it is you can do a secondary transfer with a reverse vesting, which is the jugaad. So today I need 5% in your company to discharge my advisory obligations. So you give 5% to me today and keep a reverse vesting clause that if I don't fulfill the commitments in a definite time, those shares will come back to the founder at par value. Still needs to go through the litmus test of taxation. It has happened a lot in the ecosystem, but we still need to see case laws, how income tax looks at it. The other way is doing SARs, right? So SAR is regulated by, just coming to the table to substantiate it. Private limited company, SARs are not regulated. So again, for private limited company, it's a jugaad process, but they're regulated through the SEBI norms. So for listed entities, they are very well regulated. So we are trying to map it so that there is some structure that can come out. So what's the difference? ESOPs you can give to full-time employees, but SARs you can give to anybody, to employees also. So your consultant advisors can get covered here. In ESOPs, you give an option to the employer to subscribe to the share of the company, equity share. In SARs, everything is settled in cash. No share transaction is there, no ownership changes. So it will not impact your cap table ever, right? So like we said, there is dilution when shares are issued in ESOPs, but there is no dilution because there is no shareholding involved. The only thing is today value is X. If tomorrow value is Y, whatever the difference, will want to pay you a cash out go based on that. The capital structure will change because new shares will be issued in ESOPs. Capital structure in SARs will never change because it's a cash settled activity. And in case of ESOPs, exercise is the activity of converting your vested stock. So whenever your vesting is finished, you pay an exercise price and that's done. But in case of SARs, it is only applicable. It will only kick in when the vesting period ends, and on the expiry date, whatever will be the norms. So it will say X amount will be paid or higher of. So if the valuation has changed, some percentage payout will be there. So it will be structured in that way. But at the end of it, only a cash outflow is paid, which is taxable for the receiver as a professional fee. And then finally, ESOPs are regulated, very well regulated through Companies Act for even startups and private limited companies. But as we discussed, SARs are not regulated. They are now being used as jugaads to manage these consultants and advisors, along with the reverse vesting that we just talked about. But if you talk about whether they will be good in the eyes of the law, that again needs to be tested. That litmus test still needs to come out in case of a dispute. What happens in those cases? But right now, startups usually do issue SARs to consultants and advisors so as to give and offer them value for their services. So this was typically the deck. I've deliberately kept it till now. I think we still have done half an hour. So we'll be happy to look at the questions that are left and see practically what are the difficulties that founders are facing.
Thank you, Sambhav. I think you've covered a very large chunk of all the questions that we had received, but there are still a few which are left unanswered. And let me start picking up some of those which I can see. So one of the common thing that I'm seeing, and a couple of audience, a couple of people from the audience have raised, is what is the right time to issue the ESOPs? I know that you did mention that when you're going for an investment round, because the future investment don't want to see dilution because of ESOP release and all that. So what about a company which is totally bootstrap and they don't plan to raise funds? Is there a formula? Is there a standard benchmarking of this is the right time? I should roll out some ESOP policy.
So if you are bootstrapped and you never want to raise funds and you are in a profitable company, even more so, then I will want my employees to be a part of that growth. So as we discussed, you just need to keep a pool early on that 8 to 10% is what I am willing to dilute myself as part of employee welfare. That does not mean it happens on day one. So you're keeping a pool, and that will dilute over a period of time. Maybe you will not be required to build another pool for next 10, 20 years, right? So based on what valuation you are giving the options to the employees, you can utilize that 10% for as long as possible. But it should come at a very early stage. For a bootstrap startup, as soon as they are willing to roll out these grant letters, or they have thought in mind to give somebody an ESOP, prior to giving them commitment on just a joining letter that you will get a 20 lakh rupee worth of ESOP, formalize everything, put it on cap table, and then do it. It's not a very easy process.
And how bulky is the whole process, right from ideating that I need to roll out a ESOP, I need to roll out ESOP, I need to release ESOP, so I need to start thinking about my ESOP policy, and then from there to actually rolling out the ESOPs?
It's not more than a month exercise, to be honest, and that also includes training the employees, right? So today, if a founder comes to us, we'll do 2 or 3 iterations to run them through the scheme, because scheme document is more or less templatized. The only thing is you need to figure out vesting kaisa hoga, quarterly chahiye, yearly chahiye, half yearly chahiye, cliff period 1 year hai, usko बढ़ाना है नहीं बढ़ाना है, और कोई restriction डालना है. So you discuss all those terms and conditions, and in about a week or so you will be able to freeze the ESOP scheme. From there on, it's more a secretarial process. So within 30 days time frame, you can close everything, and you can even do an employee training before you issue the grant letters, so that they also have the right skill set to ask the right question at the right point of time.
And I'm assuming that ESOP, because I have made an announcement that yes, we have rolled out ESOPs, it would be considered as part of the due diligence when I'm going for the subsequent fundraise.
Absolutely. So supposing you have a letter which says, like I said, because it's a very practical thing that happens. If there is a joining letter which says you will be given ESOP worth 20 lakhs, the DD guy will ask for the ESOP scheme. And if it's not there, he'll raise the red flag that, oh, ESOPs have been given. And in some cases, 2 years have also gone. So now they are required to restructure the whole thing. So if somebody has been given 4 years vesting, now formally he'll be given just 2 years vesting, because those also nikal gaye already uske through the joining letter. So all that kind of workings will start.
There is a question around ESOP. Now, how is ESOP similar to ESOP, or I'm hearing it for the first time?
Same here. In fact, I did some research on this. I think it might be management SOP, but I will like to skip this question. It's pretty wide space. Nothing technically is available. So it's just like a SAR thing, right? It's a jugaad thing that could be there, but at the end of it, it's ESOP only. So I'll give you another example. So people are using iSafe, right? So everybody is saying iSafe instrument. iSafe is not an instrument. Underlying instrument is CCD or CCPS. So MSOP is somewhat similar category. Ultimately, it will be a subset of ESOP only.
Study you want to highlight where ESOP worked out in the negative direction?
So there was this dispute. In fact, it became a co-founder dispute later on. Same thing, right?
You can choose to avoid taking the name of the company.
Of course, I will not take that name. Yeah, and there are many, right? And that's the beauty of startup ecosystem. You learn each day. So it will come in different colors and shapes, but the bottom line will be the same. There is no co-founders agreement. ये तो मैंने copy कर लिया था agreement और खुद ही बना लिया. Now, when there is no money, there is everything is okay. But when there is traction that comes in, that's where even personal relation starts getting spoiled. So specifically in case of an ESOP, it happened that the understanding of both the parties was different. And both parties were influential. So founder was also a repeated co-founder. This incoming co-founder was also a very serial investor and some sort of those things. And then there was at a stage when the company was growing, they were supposed to focus on the product. They focused on the dispute. And it wasted a lot of time. Matter did not solve. So if it's not implemented rightly, it can backfire also.
Some of you mentioned that when an employee is leaving your organization and the offer stands there for perpetual. By the way, that's a very rare situation I've heard of. Mostly, I've heard of people generally give a 3-month or a 6-month or a max 1-year timeline that you need to exercise your ESOP, otherwise it's gone. So, any statement on that?
So then I would say I would have been a lucky employee of an organization that I got to experience this. But when I got to, and this happened reactively, right? And I know a lot of startups that have done it after that. In fact, it created long-term brand value because even people who've gone out are still associated with the entity in some sort or the other. So it kind of creates a ripple effect, is what I feel, because you get to know how long the liquidity event is for the startup, right? So if you understand the business, you will also be equally reciprocating with the employee that by no liquidity event is far off. So then why commit? If it's not there in 3 years, why should we say 3 years?
Absolutely. And I mean, the next question is not from the founder side, but it is more from an employee side. How does the taxation work when you're receiving ESOPs from an entity which is foreign, which is not which is an overseas company?
From the employee perspective, it still remains the same. Like we discussed the numerical example, right? In one case, if it's an Indian entity, the onus is on the entity to pay the tax. Where the money comes on is a different thing. कि वो salary से कट के आएगा या employee से collect करके फिर pay होगा. So either which ways, the onus is on the entity here if you are an Indian entity. As soon as it becomes a foreign entity which has no relationship in Indian entity, the advance tax will need to be paid by the employee here, right? Because that entity might not have a implication or a obligation to pay the tax, but because the tax event is there, employee will still be required to pay it ideally as an advance tax. But we need to figure out a situation why it is like that, where they are able to have an employee in India or a company outside has an employee in India without a place of management. So there could be a holding subsidiary relationship, in which case subsidiary becomes liable. So we can go one step further, but just to answer that, if the holding company has no relationship, there is an ESOP, you're getting some substantial value, you still need to pay tax. Now the owner shifts to the employee versus the employer.
A very simple situation could be I'm employed to a startup which is based in Silicon Valley, and there's no entity they have formed there. I'm on a work from anywhere mode employee.
Correct. In that case, we need to check. I am not expert of the US laws, but if the US also has tax implication, so say US is doing that tax reduction in filing for the withholding taxes. India, US has a double taxation avoidance agreement. So if any tax has been paid on the same, this Indian person will be able to offset it. But again, that working will need to be done holistically so as to ascertain वहाँ पूरा tax पे हुआ कि नहीं हुआ. इंडिया में 35% टैक्स रेट है तो डिफरेंस एटलीस्ट यहाँ एडवांस टैक्स पे हो.
And how does the ESOP dilution happens with the subsequent funding rounds?
So as we discussed, right, initially we've kept it 8 to 10%. So number of shares become freezed. So whenever the next round raises, the number of shares are always the same that we have earmarked. So this scheme will say 20,000 shares are earmarked for ESOPs. Now, once that 20,000 is finished, then you can get another ESOP scheme.
So that option is always there for the founder to create another pool of ESOPs.
You can increase the ESOP number of shares with the approval of shareholders whenever
but that will see a dilution for the investors on the capital.
Correct. Whenever that happens, wherever that happens, the existing investors will always get diluted.
they must be asking for an anti-dilution in that case.
Absolutely. It is always there.
Okay, I see a couple of hand raised. So Sushant, are you able to unmute and
Yes, sir.
yeah, Sushant, please go ahead.
Yeah, Sambhav sir, just wanted to understand if a startup do an ESOP, then do you think that the investor will prefer those kind of companies, or they'll prefer the company which hasn't diluted the equity? Just wanted to have an understanding of this, sir.
Where investors had and then give an answer, I will definitely want to invest in a company that cares for its employees. I will
Okay.
not want to work with founders who are
Yes, sir.
not savvy
Yes,
of
I got
creating
it.
ESOP pools and adding value to the overall ecosystem.
Mhm.
So it's
Fine.
perspective, right? It's just
Yes, sir.
And
subjective.
also
got
the
it.
investor also understand that at some point of time you will have to create a ESOP pool. Why should I
Absolutely.
get
Yes.
diluted because of your ESOP pool? So they would
Yes.
always expect you to do that piece before they join your capital.
Yeah.
But sir, what about the valuation of the company? Then it increases or it remains the same if I issue the ESOPs?
You will need to value the company. So if you're raising a round today, right, your
Hmm.
value could be, so you can give the ESOPs at almost the same valuation. So,
Okay.
so assume I'm not raising any round today,
Mhm.
but I want to value the company. I can still value the company based on my revenue, my projections and all. So today, say I valued the company for the purpose of ESOP at $1 million.
Hmm.
Now, so my company is now valued at 1 million. So now if an investor comes in and says, no, I want to value at 500K, then those ESOPs have now got reduced. I mean, those
Yeah,
people
it's
have
got diluted.
value got eroded for them.
Yes, sir.
Then I want to raise the next round at 5 million or 10 million. So as the ESOP holders at least become more confident.
Yes, got it. Thanks.
Some questions in the chat box also.
Yeah, I got the access to the chat. So yeah, we are invested through CCD. So at what valuation we issue ESOPs?
It can be the same value for what you kept floor price for your CCD.
Okay.
Yeah.
I can speak now. I think something was wrong.
Yeah,
with
Ashish,
my
please go
video.
ahead.
Go ahead.
Yeah.
Can I ask a question?
Yeah, please go ahead.
So I created for this before we get funded. Hopefully that happens soon. We created ESOP pool, so we are doing that. My only worry is that if I have, let's say, I keep aside 10% of the shares and they don't get used in next 5 years, just for the sake of it, but I don't end up using those at any point of time or not finishing them all of it. Maybe I use 8%. What?
Yeah, so we need to look at the two routes that we talked about. One of the route was trust route, where you've allocated the shares. So share now exists, but that ownership is with a trust. So of course, people have got diluted because of that allotment, but those shares are not with any third person. So they are not a liquid shares. Let's talk about the process that we follow, right? Where we are just keeping a pool. Shares are yet not allocated. So assume you have a pool of 2000 shares, and out of that, only 400 are allocated. 1600 are still left. So you are still not diluted till the time they are allotted, right? So your dilution will only happen when you have given those to some employee and they have exercised it. Till the time they are in the pool, that's just a assumptive dilution for the purpose of cap table for existing and incoming investors. But the actual cap table will never say that dilution has already happened. So the shares do not exist even today. They will exist only when they are granted, vested, exercised, and then allotted. Till the time they are just a number, that's all. So tomorrow, say 5 years down the line, you have 2000 shares and only 500 have been done. It's okay. That's fine. That's how the cap table will look like. 1500 will not exist on the books.
So I see a question from Vasant Kamath. Is it better for the company to manage ESOPs end-to-end on behalf of employees, or leave it to the employee, or have a blended model?
Of course, it has to be a blended model. And most of that working has to be done at the company's end, right? You need to automate things. So there was one question around how to manage. So there are a lot of SaaS-based software now. Kata is one, My Equity is one, where you can automate all these functions, and the employee also have a login details. So they can go in, check how it is running, what's the current valuation, and they can do decision-making accordingly. So of course, you cannot leave it only to the employees. You have to be the enabler for them to take the decision. So it has to be blended with, I would say, 95/5 in employer-employee ratio.